Happy day students. Today's class we are going to discuss about the basic concepts and the definitions under the Income Tax Act 1961 and also about the tax rates that is prevailing for the previous year 2021 and assessment year 21-22. The hardest thing to understand in the world is income tax. This is according to Albert Einstein. Let me make it as easy as possible for you to understand the subject and to go into the brief history about the income tax in India. It goes way back to Kautilya's Arthashastra and Manusmriti, the ancient Indian law, which has mentioned about this tax system that was about 2300 years ago. It was mentioned in the Arthashastra and Manusmriti that the people pay 1/6 of the share, which is known as bhagas, to the king, and this was to enable the king to protect the traders and for the welfare of the general public. Okay, and that was the reason which was mentioned in the Manusmriti and the Kautilya's Arthashastra for the tax system which was prevailing in those days. Okay, and in India it was started in 1800s, late century of 1800 and then 1900 beginning also, but there were numerous amendments and all those years. Okay, so finally the Income Tax Act was passed in the year 1961 and that was into force, and that came into force with effect from 1st April 1962, and we refer only to this act for all concepts and definitions. Okay, and then we refer to the Indian Income Tax Act. Though it was in 1961, the concepts, definitions and all, there won't be any changes that much as the years get changed. Okay, but the rates definitely will change according to the Finance Act that is passed every year as per the Union budget that will be kept before the House of Parliament, and upon the approval of the members of the Parliament, the Act will come into force. So it will be governed by the amendment that is passed in the every year Finance Act. Then the tax is a mandatory liability. Okay, but still every citizen of India who are the taxpayers and whose income is above the exempted level will always raise a question, why should I pay tax? So there is always some sort of criticism, a sarcastic comment among the taxpayers. Why should I pay tax? Whether I like it or not, I have to pay tax. And then they also say that, and when you don't pay, they take it. Okay, and they say that the IRS, which stands for Indian Revenue Service, and together they say it's all theirs. So whatever we earn, that goes to them. That is what they say. The IRS, it's all theirs, and they say that like it or not, we have to pay. Okay, so that is what the criticism, or we can say some sarcastic comment that will be passed by the taxpayers regarding this tax payment. Okay, and there are a lot of questions also they raise, okay, stating that what are my taxes being used for? Okay. It is my income and I pay tax where this tax money has been used. Okay, so I need answer for these questions. Okay, so that is what they ask, and now here is the answer for that. Okay, see, the government spends the tax money for lot of welfare measures for education, health care in the form of government educational institution, government hospitals, and there are certain sectors from where we don't get revenues. Okay, but there will be more administrative costs, expenses. Okay, like defense, police. Okay, we don't even know that there are people who give protection to us from our alien enemies. Okay, who stand near the border, who stand near the difficult area, remote area, who protect us. Okay, and for them government has to spend. There are expenses, and there is expenditure, administration cost, and there are judicial system where there is no revenue, but there will be expenses by the government of India which will be met only out of this tax. Okay, and then the government also provide, whether we know or not, we enjoy the benefit in just for example in the form of the cooking gas which has been provided at a subsidized rate, or it will be subsidy will be provided for the facilities. Okay, and so we have to appreciate that we should not consider that as a donation or a voluntary contribution. It is our obligation, it is our duty to pay the tax. We should accept it as a responsibility. Okay, and here we should act like a responsible citizen. Okay, here I just want to mention about a recent case. You must be knowing about it. There was a Madras High Court strongly condemned and imposed a penalty on actor Vijay for evading the tax for his imported Rolls-Royce car from England, where the actor pleaded that he paid the customs duty for the import of the Rolls-Royce cars from England, but he pleaded to evade the to get exemption from the entry tax, but it was strongly condemned by the High Court, stating that an actor who project himself, who portray himself fighting against the corruption and fighting for social justice, okay, who has influence upon his followers, should act as a responsible citizen, and where there are more people influenced by his act, he should not indulge in these type of tax evasion practices, okay, and the High Court imposed 1 lakh penalty on the actor, and it was to be deposited for the Chief Minister's COVID-19 relief fund, okay, and so here actually they should, what we come to know about from these cases are, tax is not considered to be a burden, or it is not considered to be a way to escape, to evade it, okay, so we should not indulge in any sort of illegal forms of evading the tax. Next, here we go to the important terms, definitions under the Act. Okay, these are the terms and definitions which we are going to discuss in this presentation. To start with, assessee, assessment year, previous year, definition of income and residential status, heads of income, and we have salary and income from house property computation, the slab rate as well as the rebate under 87A. Okay, now to start with the definition of assessee. Okay. According to section 2 subsection 7 of the Income Tax Act 1961, assessee is defined as a person by whom tax or any other sum of money payable under the Act. Okay. Tax. So definitely person who earns income should pay the tax. Person who pays tax will be the assessee. What do you mean by any other sum of money? The any other sum of money refers to the fine or the penalty which will be in the nature of interest. So assessee also includes the person who pays the other form of money which includes the fine, penalty which is in the nature of interest. Okay. And assessee can be a deemed assessee, and assessee can be a representative assessee or assessee in default. Here the deemed assessee refers to an assessee can be an assessee for a person who will be the principal who stays outside India, who may not able to have a return filed by him in person. He could have the deemed assessee to represent him. So assessee could be a deemed assessee, he could be a representative assessee, assessee in default. Not necessary he will be an assessee only if he pays the tax. Even if he doesn't pay tax, he delay in pay tax, or there is no tax in that year, he will be considered to be a person in default. Okay, so as he will be assessee in default. That is the definition of assessee. Now we have the definition of assessment year and the previous year. Okay, actually these two definitions we have to discuss together, because as it goes hand by hand, if the first, I'll tell you what is previous year, then we'll discuss about assessment year. Previous year, the year in which income is earned is known as previous year. Okay, and the year in which that income is assessed for tax is known as assessment year. Why we have these two different year concept, that you could understand from the last point. Both previous year and the assessment year is covering the period between starting with the 1st April of the financial year ending with 31st March of the next year. In that case, we are accountable for all our income and the expenses which we are going to claim during the period starting with 1st April ending with 31st March. In that case, if the previous year and assessment year is going to be one and the same, we can't be accountable for all that income or expenses which we have it on the last day of the year, that is on 31st March. Okay, so the year in which income is earned is a previous year. That year's income will be assessed for tax only in the following assessment year. That is why we have these 2 years concept. One is previous year, another one is the assessment year. I repeat, the year in which income is earned is known as previous year. The year in which that income is taxable is known as assessment year. Both previous year and the assessment year will be covering the period between April to March. Okay, in that case, I was telling in the beginning that we have the Finance Act passed in every year, and the tax rate will be prescribed only under the Finance Act. Okay, then which year tax rate we have to apply for the income? Is it the tax rate that is applicable for the previous year, or is it the tax rate of the assessment year? According to the provision, we have to apply the tax rate of the assessment year. The year in which that income is assessed for tax, that year tax rate only will be applicable on the income. Okay, I think you can understand the concept of previous year and the assessment year. Okay, now when we are learning the income tax, you will be in the assessment year, because you will be assessing the income of the person which is earned in the previous year. Okay, so always when the students learn this subject, they will be in the assessment year, and you will apply the tax rate of the assessment year for the income earned in the previous year. Okay, now we are going to discuss about the definition of person. Why person to be defined under the Act actually? It is for the reason that no person can escape from the tax liability. Every person who earns income will supposed to pay the tax. Okay, so the Act defines who are all the person. The person includes an individual, Hindu undivided family, company, firm, association of persons or body of individuals incorporated or not, and artificial juridical person, even local authorities also. Okay, so these are the people that has been given under the definition person. Okay, and here if you have noticed, you know all these people: individual, Hindu undivided family, a joint stock company, a partnership firm, local authorities which includes the corporation, municipalities, panchayats. Okay, and also about the association of person or body of individuals incorporated or not. Okay, and finally artificial juridical person. Artificial juridical person actually refers to the people just to avoid the tax liability. Simply they claim that they were doing business with God and they pay a part of their income to God. Okay, and that is how they claim exemption for that income. Okay, so the Act includes even the artificial juridical person. For example, you say you do business with Lord Krishna and offer his share. Lord Krishna will also be taxable under the Act, and he will be liable for the tax under this category, artificial juridical person. Now you can understand better the meaning for why these persons and all to be defined under the Act. Okay, so you have learned so far the definition of assessee, assessment year, previous year, and the definition of person. Okay, now we'll move on to definition of income. This is according to section 2 subsection 24. Okay, and income definition, income should also be defined under the Act, because only if the Act says no what are all income, that if it is treated as an income under the Act, it will be taxable under the Act. As per the Act, if it is not treated as an income, the meaning is it is not liable for tax. Okay, and so we should know the definition of income, and it is not an exhaustive one, it is an inclusive definition, because the income varies from person to person. It is not one and the same. For example, a salaried person, if we ask him, his income will be income from salary. A landlord, his income will be the rent from the house property. A business person, his income will be the profit income. So it varies from person to person. Okay, so in that case it should be what are all the income. Okay, we have all that could be included under the term income. Okay, so it includes profit income, if you have invested in the shares, dividend income what you earn, it includes interest income on your bank deposit, it includes any payments made by the employer to employee in performance of his official duties, in discharge of his official duties, perquisites, okay, and capital gains, and all other contributions which has been received by the charitable trust, religious trust, hospitals, educational institution in the form of donation. These are also treated as an income. So this is a definition of income under section 2 subsection 24, which is an inclusive definition, which includes, you can just include what are all the income that you come across in your life. Okay, all that will be included under the term income. Okay. Now we are going to discuss about the residential status and its provisions. Next is the concept of residential status. What we should discuss about residential status under the Act is actually it has a direct bearing on the tax incidence. A person who is a resident in India is taxable in India. Okay, and a person who is a non-resident in India is also taxable in India, but only for the income that is earned in India, not for the income which he has earned outside India. Okay, so in order to understand the concept of tax incidence, you should also understand the concept of residential status. I live in India, I am a resident in India. No, definitely not. Okay, you live in India, it doesn't mean that you are a resident in India. Okay, of course we are all resident in India if we don't travel abroad. Okay, but the people who are into business, who are into multinational company, multinational business, a global level and all that, they frequently travel abroad. Okay, so in that case they stay in India for they stay in different countries for different period. Okay, so how to determine the status of resident in India or not in order to make the person taxable in India? Okay, we have the provisions given under the Act. Act says that there are two basic conditions. It is enough that if the assessee satisfy any one of the basic condition, he will be a resident in India. I repeat, if he satisfy any one of the basic condition, not necessary he should satisfy both the condition. Okay, the first condition is the assessee should stay in India for a period of 182 days. 182 days in the previous year preceding the previous year I refer to the financial year. Okay. So, for the first condition is the assessee should stay in India for a period of 182 days in the financial year. The second basic condition is it is enough if he stay for a period of 60 days in the financial year, but in the past 4 previous year, he should stay for a period of 365 days. Okay. Then he will be a resident in India. So, the second basic condition actually has 2 parts. Okay. That is, first part is in the current financial year, his stay required for 60 days, and in the past 4 previous year, the stay required for 365 days. He should fulfill both the parts of the condition to be a resident in India. But the first part is he stay for 182 days in India during the financial year. So, if he satisfy any one of the basic condition, he will be a resident in India. Okay. And there are certain other provision related to the residential status. A person can be a resident in India in more than one country. It is not like that if he is a resident in India, he should be a non-resident in another nation, because in India the stay required is only for this many days, 182 or 60 and 365. So, similarly some other nation also might have only a lesser number of days, not all the 365 days in the year. So, he could fulfill even the conditions of another country also. So, he could be a resident in more than one country. Okay. And then to determine this number of days in India, the stay does not require to be continuous. Okay. So, he can stay for some 100 days and then he can go abroad again, he can come back and stay for the remaining period. Okay. So, stay need not be continuous, and he can stay anywhere in India, not necessarily in only one particular place, continuous stay for these many days. Okay. For part of a period he could be in Chennai, the remaining part he could be in Delhi. Okay. And he could enjoy different status for different years. Okay. That is not necessary if he is a resident in 1 year, means he should be continue to be a resident in all the years. The next year he could be a non-resident, again he could become a resident. Okay. So, he could enjoy different residential status in different countries and different years. Okay. And stay need not be continuous, he can stay anywhere in India on the water, or not necessarily only on the land, he could be flying on the air also, and the day he enters India, the day he leaves India will also be counted for his stay in India. Because you will learn now the basic computation of the income from salaries and income from house property. We have different heads of income. As such, as per the Income Tax Act, we have 5 heads of income. First is salary income, house property income, and income from profit and gains of business or profession, income from capital gains, and income from other sources. In this presentation, we are just going to discuss about the first 2 heads of income and its computation, and in detail we will be discussing on the respective chapters. Okay. So, just I will show you about the computation of salary income. And salary does not refers only to a consolidated salary. It has its own breakup, like it includes perquisites, allowances, retirement benefits also included only under the head salary. So, add up the emoluments whatever is paid by the employer, and then claim the deductions what is allowed under the act. We have the deductions allowed under the section 16, and we have 3 deductions allowed under section 16. The first one will be the standard deduction. A fixed amount of rupees 50,000 will be allowed, or the actual salary income whichever is less. So, definitely the salary income will be more than 50,000 nowadays for everyone. Okay. If at all the salary income is less, that will be fully allowed as a deduction, or else it will be a fixed sum of rupees 50,000. This is standard deduction under 16(1). The next will be we have entertainment allowance under 16(2), which is allowed as a deduction only for government employees. Okay. And so, for private sector employees this is not allowed as a deduction. And finally, under 16(3) we have professional tax allowed as a deduction. So, these are the 3 deductions allowed under the section 16 under the head salaries. Okay. Apart from this, every allowances and perquisites has its own way of computation, and there are certain exemptions for certain allowances, and there are certain tax free perquisites also, which will be discussed in detail in the respective chapters. Okay. And next will be the computation of house property, and under house property actually we divide the property into self occupied property, let out property, and deemed to be let out property. Actually, the assessee is allowed to claim only one house property under his occupation. It is misunderstood. He can't stay in more than one house. Okay. So if he claims 2 or 3 houses under his self-occupation, that is not accepted under the law. Any one house according to assess his choice but. Okay. So for which the value is more, he could claim it as self-occupied, and that house value will be taken as nil. The other houses will be treated as deemed to be let out property. Okay. And if the property is actually let out, that will be taken as a let out property, and we have to compute the income under the head income from house property. So I repeat, only one house property will be allowed as a self-occupied, for which the value will be given as nil. The assessee doesn't require to pay any tax, but he can claim one deduction under the self-occupied property, which will be interest on borrowed capital. If you borrow a loan and pay interest on but here the interest for borrowed capital is allowed only for 5 purposes in connection with house property: purchase, construction, repair, renewal and reconstruction. Only for these 5 purposes, if you borrow loan and pay interest, that will be allowed as a deduction. For a self-occupied property, the income will be taken as nil, but one expenditure will be allowed as a deduction, which will be interest on borrowed capital. So always it will be loss from self-occupied property. Okay. Now we'll move on to the computation for let out property. We will determine the annual value. As I said, we are going to discuss in detail in this chapter later. So I'll tell you how to determine the annual value. With that annual value, we'll claim the municipal tax, which will be the tax payable to the government. As a deduction, it will be allowed, and this is for the let out property only, and we have 2 conditions to claim municipal tax as a deduction. First is it should be paid by the owner. Okay. So tenant pays municipal tax will not be allowed as a deduction, and next is it should be actually paid, then only it will be allowed as a deduction. 2 conditions to claim municipal tax as a deduction: it should be paid by the owner, and it should be actually paid. It should not be kept due or outstanding, then it will not be allowed as a deduction. Okay. And the balance will be called net annual value. From the net annual value, we can claim deduction under section 24. Like how in salary income we claim deduction under 16, in house property we claim deduction under section 24, which will be standard deduction. Like salary income we had standard deduction of 50,000. Here it will be standard deduction 30% on net annual value. So what is net annual value? Gross annual value minus municipal tax will be the net annual value. From net annual value, we are claiming the deduction. Standard deduction is 30% on net annual value. And what is the reason to claim the standard deduction? We discussed this even in the salary income also we had the standard deduction. Even in house property also we have standard deduction. Actually, the explanation will be the common for both. Okay. See, in salary income, if you take, definitely an employee will incur some petty expenditure. Okay. He travel to meet the customer, he offer him a tea, or when a customer visits, okay, when they have a meeting and all that, for all this petty expenses and all, he can't claim it, okay, from the office. Okay. So for which he will be allowed to claim a standard deduction under the head salary. Similarly, for house property, there will be lot of expenses like repairs, and they may undertake some, there will be depreciation, there will be insurance. Okay. They will cover the property with insurance. Okay. And they will create a charge on the property. That is called as annual charge. Okay. See, for example, the father, when he transfers the property to his son, okay, with the condition that you have to pay a part of rental income to your mother for her maintenance. Okay. So for which he would have created a charge on the property, which is called annual charge. So previously all these expenses were allowed as a deduction. Okay. Depreciation, repairs, and then sometimes they pay ground rent. Okay. And then in annual charge, and then collection charges. You may collect the rent through some person also for whom you pay collection charge. So previously all these were allowed as a deduction, but there's no uniformity, and each person will claim different amount as a deduction, and as such, to avoid all this, there is a standard deduction concept introduced where you can claim 30% on net annual value as a deduction. And again, on let out property, you can also claim interest on borrowed capital only for the purpose for which you borrow, which will consist of repair, renewal, reconstruction. Okay. These are ancillary purposes. Apart from the purchase and construction of the house also, loan could be borrowed and interest will be allowed as a deduction, and the balance will be the taxable income from house property. Okay. So this is how the salary income and the house property we are going to learn in detail later, but I have given you the basic steps in computation of it. Okay. Now here the next is deduction, and actually every income has its own. Now in salary, income and house property you have saw the deduction under 16 and 24 respectively. Okay. Now what is this deduction actually? That 80C only I am going to explain here, but let me tell you what 80 deduction is nothing but chapter 6A gives you a list of deduction which could be claimed against gross total income. So what is gross total income? The aggregate of all the heads of income is known as gross total income. From gross total income you can claim the deduction under sections 80. Okay. And under section 80 we have a list of deduction, but here I am just going to explain you about 80C alone, because for salary people, okay, that the income group, okay, for individuals especially, okay, 80C will be the most common deduction that will be allowed. Okay. So 80C alone we are going to discuss, the remaining sections of 80 we will discuss later. Okay. And 80C, the maximum limit you can claim all these expenses as a deduction is only up to rupees 1,50,000, or if it exceeds if it is lesser, okay, the actual expenses, or because the 80C includes investments as well as some payments also. Okay. If these payments or the investments exceed 1,50,000, it will be restricted to 1,50,000. It will be if it is less than 1,50,000, you can claim only to that extent. Okay. So this is a deduction allowed under 80C. Just to name few items that will be eligible for deduction under 80C is life insurance premium that has been paid on own life of the spouse and children will be allowed, and employees contribution to provident fund, recognized provident fund, statutory provident fund, public provident fund will be allowed as a deduction. Tuition fees paid for children, and repayment of housing loan, okay, and then unit linked insurance plan and equity linked saving scheme, investment in mutual funds. Okay. So these are all the most common items. And now Suganya Samrithi's account for the girl child, investment for the in the bank deposit for girl child. Okay. So all these are newly added items. So we have around list of some around 19 to 20 items we have it under 80C, and this includes investments as well as the payments that could be made by the assessee. This is allowed for individual and HUF, because if you see these expenses and the payments and all mostly made only by the individual or by the HUF, not it is not for the company and all doesn't go for these type of payments or investments. Okay. So this is allowed only for individual and HUF, and the restriction is up to 1,50,000 you can claim it as your deduction. We will have a look into the slab rate that is applicable for an individual who is less than 60 years of age. Now the second slab is from 5 lakhs to 10 lakhs. Okay. So here you have to pay 20% of the income that is exceeding 5 lakh. Okay. So if my total income is 6 lakhs, okay, let me enjoy the benefit up to 2,50,000, the tax is nil. Okay. So let me pay not any tax on that first 2,50,000. The next 2,50,000, what I am supposed to pay is only 5%. Okay. So let me pay 5% on the next 2,50,000, which comes to 12,500. So now the excess is going to be only 1 lakh. On that 1 lakh I will pay at the rate of 20%. Okay. So let me not apply 20% tax rate on that rupees 6 lakhs. Okay. So let me enjoy the benefit what is provided under the Act. Okay. We are not violating any provisions. We are following strictly the provisions of the Act only. Okay. And to minimize our tax liability, and this is how it has to be computed. Okay. And now finally, if the income is above 10 lakhs, okay, the tax rate is 30%, okay, of the income exceeding rupees 10 lakhs, okay. So that means that excess of 10 lakhs only I have to pay 30%. So let me enjoy the previous tax brackets of first 2,50,000 nil tax, next 2,50,000 only 5%, okay, and next 5 lakhs is only 20%, okay. So if my gross total income is rupees 11 lakhs, then on the excess of 10 lakhs, on that 1 lakh which is at excess, on that only I will apply 30%. Otherwise, the tax will be first 250 was nil tax, next 250, that is 250 to 5 lakhs, it was 12,500, and next 5 lakhs to 10 lakhs, on that 5 lakhs it was 1 lakh. So 1 lakh and 12,500 plus 30% on the excess of 10 lakhs, that is going to be my tax liability. Okay. On this tax computation, finally we are going to add health and education cess at the rate of 4% to determine our total tax. Okay. And here health and education cess 4% is not on income, it is on the tax. Okay. Then after this computation, finally we will discuss about the rebate allowed under 87A. Rebate under 87A. rebate under 87A will be allowed if my income is not exceeding rupees 5 lakhs. That means if my income is up to rupees 5 lakhs, I am eligible to claim rebate under 87A, which will be rupees 12,500, which is the amount that has been given under the Act, or actual tax payable, whichever is less. Okay, and this is available only for the resident individual, and income should not exceed rupees 5 lakhs. Then the rebate will be 100% of the tax, or rupees 12,500, whichever is less. For example, my tax itself is rupees 10,000. Okay, then my rebate will be full amount of tax will be allowed as the rebate. Okay, if my tax is exceeding 12,500, it is going to be 13,000, then I could claim only up to 12,500. Okay, so this is rebate under 87A. Here, if after computing your total income, if your income is up to rupees 5 lakhs, even before computing the tax liability, okay, if your income is up to rupees 5 lakhs, compute the tax liability, don't add on health and education cess, you can claim rebate under 87A. Okay, so no health and education cess will be to be added with the tax liability if your income doesn't go beyond 5 lakhs. Okay, and here one more point I have to tell you, the income or the tax which we are computing, we have to round off to the nearest 10 for easy computation of tax liability and all that. It can't be in fraction. Okay, so 5 and above to the next 10, less than 5 to the previous 10. Okay, it is not to hundreds, it is not to thousands. Okay, you have to round it off to the nearest 10, because it is a huge burden. Tax itself you are finding it as a huge burden, then you are converting to 100 or the thousands, then it is going to increase your tax liability. So convert it to the nearest 10 only, both the income as well as the tax liability. Okay, so today's class we discuss about the basic concepts under the Income Tax Act, the definitions, even we discuss about the history of the income tax and all important terms like definition of assessee, assessment year and previous year, income definition, okay, and definition of person, then how to determine residential status, okay, and tax incidents which is related to the residential status, and the heads of income. We had 5 heads of income under the Act, but we just discuss about the basic computation of 2 heads of income, which is salary and the house property. Okay, and we discuss about the slab rate that is applicable for an individual less than 60 years of age. Okay, and we are not discuss, we didn't have any discussion about the individual exceeding 60 years like senior citizen, super senior citizen, only about the individual less than 60 years of age, that was the slab rate applicable. And also we discuss about health and education cess, and finally rebate under 87A. That is for the today's session, and we'll discuss about the remaining in the next class.